All right, good evening. My name is Daniel Young. I'm the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. And I am back to talk closed-end funds and overall investment strategy with a twist. This is an unedited video. Who knows what you'll hear in the background as I film these in my house. I am not a financial advisor. I am a strategist, and I don't speak like the herd. I walk in limited company, and sometimes I walk alone. So I have no notes for the week. This is really just a completely unedited, non-filtered, non-whatever video. Um, and it's going to be different than normal. I can tell you what I know based on what I've read, but the honest truth is, and when I started making these videos, I promised honesty, I promised transparency, I promised not to fluff anybody's pillow or blow smoke up anybody's butt or backside. Um, So the truth of the matter is, everything I wanted to happen this weekend financially didn't happen this weekend financially. Saturday was a work day in the sense of I had house projects and they ended up being unfinished house projects. I got one thing done. I had a fireplace to fix, but couldn't fix it, have to order parts. Had a sink to repair, couldn't fix it, have to order parts. Um, the only thing I did Saturday after all these other stuff, like besides spending time with my girls, and having a good date night. Besides that, I cleaned our shower head and had like an hour and a half long conversation with one of my closest advisors that gave me a lot more to think about than I realized. I thought I was giving him an update on things that were happening in our life, and the questions that he asked me in return gave me a lot more to think about than I realized, which is really good. And I've said this before. So when it comes to your life, you can section it out by life and finances and however else you want to categorize your life. Uh, Church, Christianity, cars, like however you want to subdivide it, or they can all be the same. You want a good, you want, Kiyosaki says it this way: you want a board of directors, or you want people who sit at your table. And I always say board of directors, but you're the one making the decisions for your life. So you want a table of people. Now, the table size is really dependent up to you. The bigger it is, the more problems you have. But if you only have one other person there, even if it's Warren Buffett, you're only hearing one other thing. So in your table of advisors, you want people who are on similar paths than you or similar paths as you. You want them with similar interests. You want them with I mean, honestly, you want amazing talent. If you're the dumbest one in the room, that's okay because you have all of these amazing people advising you. Um, and our board of directors, or at least the people who sit on our table besides us, isn't that big, but they also offer a lot of insight. They're people that who can look us straight in the eye and call BS, or they can look us straight in the eye and say, "Hey, like, tell it to me plain," and they'll tell it to us plain. And for us, that's really unique. And I'll put it this way. So Kiyosaki said, you want the same kind of universally in what you're doing. Like if you're really interested in the stock market and your tax guy is really interested in real estate, that's great. But if he doesn't know all the ins and the outs of helping you out in the stock market and he's not similarly invested, that's not exactly helping you out the best. Um, if your stock advisor is investing in stocks, and at the same time, he's heavily invested in real estate and more concerned about real estate. It's great that he's your advisor and it's great that you're like stocks too, but his priority is actually somewhere else. That's not helpful. Um, so for us, when we started to look into the market and then also look into the real estate market, we realized that although we had people that we trusted, we didn't have maybe the right people in the right places. And we've cleaned up our board. considerably. Uh, and I guess that kind of segues into what I've told y'all that we have money in a Morgan Stanley account with a guy who, oddly enough, that I was expecting this to go a completely different route. I was expecting us to run into roadblock after roadblock after roadblock and not be able to make headway with the same guy. But he was like, I'm open to work, like I'm open to y'all being self-directed. I'm open to y'all calling the shots. I'm open to y'all investing in closed-end funds or whatever you want to invest in. Uh, like we're, it was kind of the passive aggressive, like we'll see how it goes because I mean he does get paid based on how well we do, which I'll come back to. So I mean he wants us to do well, but at the same time he doesn't know how well we'll do. And we were ready to move ahead in the sense that like we sold our portfolio. Um, but then I talked to two of my good friends and two of the people who sit at our table financially and in a lot of other ways. And they both gave me a lot to think on. And it's like so great. Like you stay with the same guy who's willing to work with you. But almost like why would you stay with the same guy? Because you're essentially paying him to manage something that he's not calling the shots on. So now he's making money off all of your work. Fair point, but I think we would run into the same problem somewhere else. Like if we went to Schwab or Edward Jones or Merrill Lynch or pick your brokerage, if so long as we have an advisor who's over our account, I thought we would run into the same problem. So it really doesn't matter what brokerage we're at, so long as somebody else is there and doing all the stuff. Just makes more sense to leave it somewhere. Then makes it more sense to leave it where it is with a guy who's willing to work with us. And then one of those advisors asked, well, what if you moved brokerages and the brokerage charged a lower fee? Like even if you had an advisor, or maybe they allowed you to be self-directed, where you didn't have an advisor, you just had somebody there who met with you occasionally. If they charged lower fees, would it be worth it? And that presents almost a whole new world of possibilities. So if we stay at Morgan Stanley with a guy who's willing to work with us, with a liquidated account that we can invest, that I can invest however we want, that's interesting. But now that the account's liquidated and we could move it wherever we wanted to, what if we moved it to a brokerage where either A, we had a pseudo advisor, somebody who's there and would, get like annual updates on, hey, here's where you are, where do you want to be, here's what you have to do. Or somebody in general who would do the same stuff but also charge less. That's an interesting concept. So, in my due diligence, I will look into that. So, I know Fidelity has low fees, and this Weeple has low fees, which is why we picked that account as part of it. Um, we liked it was user friendly. It was newcomer user friendly. It was super low fees. Like I think I've paid maybe 3 cents at one point on selling some shares. Um, but generally I pay nothing. So, and I still like the program. Don't get me wrong, but I'm also kind of it's not the diversification for diversification's sake. It's not that, but it's kind of the spreading your risk in the sense of I don't want everything at the same brokerage. Uh, we have we have a cash account with Webull, meaning like we have an individual brokerage account that's taxable with Webull. We have a Roth with Webull. If we opened up the same formats, like an individual account uh, with a Roth account, or even an individual and a Roth, and like a high interest savings with a group, I like that idea instead of everything in one, just in case. Webull is reputable, Fidelity is reputable. Both seem to be long-standing funds. Webull's newer, yes, Uh, Both are structured well, all that stuff. It's just the risk part of it. Now, I don't want to spread it off into like 30 funds. That's foolish in my mind. That's butter over way too much bread. Like there's no way to grow that. But getting back to topic, and that other friend, it was like, why pay him when you're doing all the work? And that kind of goes with Fidelity. So if Fidelity would be cheaper than Morgan Stanley fees or no fees compared to Morgan Stanley fees, then I still get to do all the work that I do now for us and the Webull account that I post on these videos. And now I'm just doing it for a different set of accounts. And that's as much as there's headache in that in getting money from one account and then switching all of it and doing all that fun jazz. And it honestly wasn't our intention to do this at the start between all those different emails we sent that guy. Uh, but given the opportunity, lesser fees over time is more money in your pocket or more money in your account, depending on how you look at it, and which is really the same thing. And it's also the self-directed aspect that we want. So I have stuff to look into. And as it relates to this video, normally I break down closed-end funds for the week, but since I didn't get what I didn't get what I wanted to, I was not able to finish or do anything regarding what I wanted to do. Like I didn't cross projects off my list yesterday, and that's kind of how today went. It's Sunday is normally our chore day, getting ready for another school week, but inside of that day, I've got maybe 3 to 5 hours where I can sit down and review everything. So like I did a full system update of the closed end fund list yesterday. Like I crash coursed it. So I guess I got that done yesterday too. I crash coursed it. Every fund, 402 funds, um, just I mean top to bottom, uh, current costs or like current price, and then the current net asset value all the way down. But I haven't had time to deep dive it further than that and really look at the targets and see what's changed and the discounts and compare that to the articles that I read and what they're saying. And not that I go by what the articles say, but it's more like opinions. Like it's um, I would say the contrarian outlook sits at our table, and seeking alpha sits off to the side. It's not at our table. It's I read another article today, which is a good article by them. It was like a yearly review, um, and it had out of 30 funds listed, it listed one closed-end fund that sells for an amazing discount. I don't know where it is historically, but it sells for an amazing discount. But it pays 4%, which is inflation level on a regular year. And the author was touting this one closed-end fund, which is overweighted into funds that don't pay dividends and like solid funds, but at the same time, the fund's not paying dividends. Um, like 35% in Berkshire Hathaway A, which are like 40,000 a share and pay nothing. So it's that, it's the hope and wish thing. Like you can hope that Berkshire will go up, and it probably will. But when it goes up, you're not getting any money for it unless you sell it. So 35% in Berkshire Hathaway and like another 20% in Berkshire Hathaway B. And I mean 50% of your portfolio in Berkshire is amazing, but it really doesn't matter if you sell it or if you don't sell it. I guess you don't get a reward for owning it. So your portfolio is loaded with stuff that doesn't pay dividends, which explains why you only pay a 4% dividend. And that's break even on inflation on a good year. I mean, the Fed says it's 2%. I call BS. It's more like 3 or 4. So on a good year, you're breaking even on inflation, and on a bad year, you're losing money. And even though you're getting at it, the fund at a discount, and you're not really getting a dividend for it at that point. So it's not really on my radar. Um, so seeking alpha provides another viewpoint, and it's not just that one viewpoint on closed-end funds, but it's multiple viewpoints, but at the same time, not a service that I want to pay for or that aligns with our um, with our strategy. They're content to buy closed-end fund at premium. Outside the one that was on this report at discount, they're content to buy at premium and significant premium because you get a fat dividend. And that's not really our strategy. So they're off to the side and closed and Contrarian Outlook sits at the table. And yeah, so but back to me, it's maybe this whole thing is about me. Um, I wasn't able to deep dive articles, so I couldn't read articles. I couldn't look at the broader market. I didn't even look at CNN's Fear and Greed Index today. So I can tell you what I think I know, but at the same time, I don't know it for sure. I have the outline of the data, but at the same time, I haven't sifted the data, and I haven't really seen how all that plays into the market at large. It's overall still looks like a great time to buy bonds. Still looks like a great time to buy real estate. And since it's a great time to buy bonds, if you can find the right utility fund, it sounds like a great time for that. But I can't say I would do that. Like if it's me on half data, I don't want to buy on half data. So if it's me, I can go with what my gut tells me and what it looks like at face value, but it's not enough. And I have a lot more to read. I have a lot more to think about. I have a lot of strategy that I have to consider and how we want to move forward on that other account. And that also impacts our investments elsewhere. And I have a lot of stuff to consider and think about and strategize. And I have not had a time to do that. So I have a really hard time telling you what we'd buy or even telling you anything to buy when I don't know anything for sure. And so I can give you the target list based on the rough cut data. I mean, I can put that on screen, but I'm not going to sift through it and spend 3 hours breaking down data and reading articles and going through the list on this video. It's not going to happen. And it's probably going to be more than 3 hours. Like I said, I have a ton to read. I've got some investigation to do. I've got some phone calls to make. I've got uh, have some serious praying to do. Not that all praying is not serious, but I've got some serious praying and really just deep thinking to do on what we need to do for our overall strategy and our overall investments of where we keep funds and our investment strategy and or not so much the investment strategy of closed-end funds, but how we're going to structure whether what the funds we have at Morgan Stanley or the funds we move somewhere else, and then how that impacts our investments and also how it impacts our business and what money we leave in liquid form or in cash so that we can move around. So I apologize for not having the regular list and going through that, but I don't feel right presenting I don't feel right presenting it because I don't have all the data. I don't. Um, I mean, of what I know, the herd is still being steered away from bonds. The Fed is still manipulating the market. Interest rates went up. Mortgage applications went down, which makes sense. Uh, the long rate overall is still showing signs of just being unaffected by the short-term rate cuts. And what's incredibly obvious is nobody has any idea how the economy will respond in 8 days. I think we'll see a surge of some type. I mean, it happens every presidential cycle. When that person takes office, regardless of party, the market goes up. But what it does after that, I don't know. There are people predicting a drop of some type. Part of that's in individual tech stocks. Uh, Bigger Pockets is finally predicting a recession, and I mean we've been talking about that for 2 years. Contrarian Outlook team thinks it'll be a no landing, where the economy will just keep moving along and interest rates will just keep going up, or inflation will just keep going up. So maybe interest rates will have to respond. And all of that says is there's all of this different input, but nobody really knows. Um, there's a lot of fear in the market because they don't know how everything will go, and the market at large is getting impacted by everybody's fear about what they don't know, and it's not exactly pumping into the market yet, but pending though, I say pending, but it's as we get closer to inauguration day, we get more feedback from the Fed of going forward into 2025. Um, I don't know if we're going to know anything else or anything different in a week, but the market for the next week might be up and down a little bit more than it has just because of all of this other stuff going on. Then you have the wildfires and the fires in California. Uh, I want to say I saw earthquakes in Texas somewhere. Maybe that's off, but I know between the wildfires and this and that and the other and the winter storm and the tornadoes on the backside of the storm, all this other stuff going on. There are a lot of people uncertain about where the economy is going. And there's just general fear and uncertain sentiment, which is the fancy way to say nobody knows what the hell's going on in the market. So you have that general climate and this hopeful expectation of what's coming in a week. I think we'll see an upswing a little bit, but I don't know what happens beyond that. Uh, so I'll stick with what I said. So I'll show you what I got. But beyond this, I'm not going to sift it because I don't know enough right now. Uh, like I have what I've read so far, and I have my general wherewithal and intuition of what I feel about the market right now. I have not read about a dozen different articles about current market sentiment and a lot of other stuff that I honestly read before I do these videos. So here's what it looks like right now. Um, these are unsorted, like it's current data, but at the same time, I haven't gone through to remark the asterisks. Um, so it's a very rough look of the list. Um, and I wish I could tell you more, but I can't. I mean, I have what I would go for, but at the same time, I'm not buying tomorrow. And from my angle, I'm not buying when I feel so bad saying it. It feels so weird to say it. I just don't know because I haven't had time to sift all the data. So if you want to sift the data on your end, I mean, by all means, you can see the targets, you can free screen, you can snip it and then cross out the stuff that doesn't look interesting. And then that gives you a list. Um, I could say the what if of things like what would we be buying if I knew everything? Well, if I knew everything, I would know, but I don't know everything right now. So, as I said at the beginning, like it's still a bonds utilities market because it's a bond proxy. It's still a real estate thing, but that also doesn't mean it's the best thing to buy right now. And that's kind of the thing. So I'm going to leave it here. Um, I wish I had more to tell you, but I don't. Um, I mean, I really do. I wish I had more to tell you. I wish I could deep dive it with you. I wish I could process it like normal, but I can't. So, and I feel, I mean, that's the honest truth of things. That's the transparency of things. The weeks where I don't get to sift the data and I don't get all the background information, I feel much better being honest with you than presenting it like normal, like I have sifted everything when I haven't. So, or maybe that's not how to say that. I feel it doesn't sit well for me to present data that I haven't sifted. One, it doesn't, and normally I get to do all that stuff and then sift the data and have a better understanding and wherewithal of what to invest now for the longer run ahead. So all I can say is please cut me a break, and I will catch back up and come back next week with better data, or at least actual data of what to do now and how that plays into the long run. So, um, Outside of that, it's the normal stuff. It's have a great week. I hope you accomplish what you want to accomplish this week. And I'll leave you with advice from one of my advisors. Whatever you're going to do, don't be hasty. Don't rush into it. Don't don't have that sense of fear of missing out. In the run up unto inauguration day, there's a ton of hope coming in with the next president. And I think we will see an increase in the market, but what it does after that, I don't know. And I think we'll see an increase one because it's Trump and he's got plans, and people like plans. They like plans better than I don't know, and they like plans, and there's a lot of hope wrapped up in what he's promised and what his team has promised. And I think that'll energize the market. But at the same time, we always see with presidents coming into office this ramp up in the market before inauguration day, a little bit after, and then what it does after is kind of anybody's guess, like normal. So don't invest just in hopes of catching the ramp up before inauguration day, because as much as we all want it to continue to go up, we still don't know if there'll be a soft landing, no landing, or some type of pullback somewhere. So don't just invest for fear of missing out, because that's what the herd does. Have a strategy, sift the data, target your investment, and do that. Don't just rush into it. And outside of that, it really is. It's have a great week. I hope you have a successful week. Hope you get stuff done. And I will see y'all on another video, hopefully with more data, sifted data, and better data next week. There we go. So see y'all on another video. Bye bye.